Quote Matt Damon in one of the best movies ever. All right. Here we are. It's a fascinating story in case you saw that one. We are here. I'm on hour 4 webinars today. Shout out to the Bear Bull community for having me on earlier. Really appreciate that. And then we did an amazing webinar, or I think it was amazing, with Interactive Brokers and NASDAQ. Just prior to that, we obviously pushed out Flow Patrol, Founders Note this morning. We had Matt Cashman on Monday. So a bunch of a lot of content. Hopefully, all that is really permeating into your trading alpha. That's the goal. And then, of course, last but not least, shout out to Oliver Rennick and the Chicago Future of Finance. He's been doing that great show or episode, I should say, or episodes rather, from the floor of the SIBO. We were fortunate to join him when he did his first show. It was fun being down there on the SIBO. And that show is getting some amazing traction, and we're super happy to be a part of that. So that's going to be on at 3 o'clock today. So all the Brents you could ever want, probably more than you ever hoped for, more than you need. Thank you. What's up to Cousin Vinny? Thank you for all the tweets and things on the content, showing how you're making some money. Captain J, you like Flow Patrol? Love to hear that. Bob Tag, hello to you, sir. Stephen Shaler, you're an Interactive Brokers fella. It's a great platform. Hem says, I'm combing my hair. That is right. I got this kind of slick back look today that I don't know that it's really winter for me. Not that anything necessarily is. But I was short on time today, so I just did the old. That's kind of the Matt Damon, all right thing. I don't look anything like a Matt Damon, unfortunately. My wife probably wishes I looked more like him. Anyways. So what is going on today? Brent, stop with your annoying narratives and get to the content. I want to talk about the full thing. Hem is from the Bear Bull community. That's awesome. Incredible deal with the Bear Bull community, too. Every once in a while, I see a deal because I don't always check them before we have community deals, and that's a good one. So congrats to you guys. Let's talk about OPEX. That's why we're here. Believe it or not, there is an options expiration on Friday. There was also a expiration, VIX expiration this morning. And oftentimes around here at SpotGamma, we're talking about like, hey, everybody, the options flows move markets. And I think if you're in the SpotGamma community, you're like, yeah, well, all right, we believe that. And then there's all these people outside of the options community, which turns out there's a lot of them, where they're like, the SpotGamma guys are just talking nonsense all the time. Like, what do they know about flows and all that sort of stuff. And then you hit these interesting moments like this morning, the VIX expiration, where all of a sudden the market just kind of gets shanked, right? And the other thing that's going to be interesting about this is that the implied moves out of this event are going to be, I think, turbocharged by all of the flows that are going to be sort of unleashed and unlocked. And it's actually this kind of funny and interesting idea because what is actually the max pain scenario, I think, right now, especially if I look at my portfolio, like Nvidia does nothing and the market does nothing after this event. And the problem that I have with that is that VIX is at 24, 25. Vols are pretty rich in a lot of these names. And so can you even do nothing? Because if nothing happens and then you go to Thanksgiving, well, do you want to own puts through Thanksgiving if nothing's happening? No, you don't. So you got to sell that vol. So it's like there is sort of like this reflexivity where it's sort of like, I often talk about this where like they shoot you into the upper atmosphere and like the zero gravity. And it's like, this is super fun, but it can't last forever. Like we got to move again, right? That vol's got to pick back up as gravity. I'm not above singing Gravity from Wizard of Oz. Fam's obsessed with it. I've had enough. Actually, I don't have to go to that next week, the release of that. I'm straying significantly off topic. All right, so let's talk about today and what was so important or big about this. And, I understand a lot of times, people go, well, this is like a hindsight thing. And it's kind of funny. What happens if we watch our X feed while on X? It's like myself watching myself. The intersection of first and first. Okay, we talked this morning about VIX expiration. And by no means am I sitting here saying, hey, I knew the market was going to put up a stupid 1% rally and then blow up, right? I did not know exactly what would happen. But when you know that there is a event in terms of the flows shifting, you need to take notice of that and then appreciate when a move happens at the time you thought something would happen, be like, okay, great. I can identify the driver of the given move. in full disclosure, I actually thought that we would have a little more of a tailwind in this market over the last couple of days because of VIX expiration and vol expiration. Clearly didn't happen. So I take a full disclosure L on that one. But today we write, look, we got 9:30 VIX expiration. Watch for unusual movements around the cash open due to VIX expiration. And then what happens? Well, we put it on X as well when we saw the move, 1% rally. And then where does that 1% rally move us to? A very obvious resistance line of just under 6,700. So if you're watching this market rip this morning and you are not a watcher of the options market and you're not aware of the VIX expiration, then you're sitting there, people are front running Nvidia earnings. Oh my gosh, like I got to get in this thing. We're good. Like, okay, great. This is a blah, 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 blah. It has nothing at all to do with any of that. It had to do with the positioning flow, I would argue, because of the timing of the rally. Right at 9:30 in the morning on a pretty big VIX expiration. Anytime you have VIX kind of 20 in the 20s, that VIX expiration probably holds a little more weight. And again, it's not to say that you knew that the 1% was coming because of it, but the fade of the rally becomes a lot easier, I would argue, when you know that it was a VIX or flow induced, or you could make the case that it was a flow induced move, in which case I really believe it was. And so that fade is way easier in that situation. You can see what happens here, right? The flows are very bullish in HIRO as the market opens. We move up. There's buyers and calls and puts here, and all expiration and really zero DTE is the bulk of that flow, as you can see. That's the teal line. And then what happens when we get to 6,700? That flow rolls right over and kind of down we go. And there's just been a lot of waffling back and forth. The moves have been overall quite transient over the last several days. And if you look at the breakdown of the order flow here, it's pure negative gamma, right? No shocker here. And negative gamma means a lot of market movement. And, what is the insight that we take out of that? And now it starts to get into the whole Nvidia options discussion as we go into expiration. Before we do that, let's just put a few things in context around the Nvidia expectation. We posted this chart in the Founders Note this morning, and this shows the event vol tied to given events, right? So Nvidia earnings, we estimate as of last night, adds about 2 points of event vol. And so that is pretty significant for a single stock earnings. Normally you'd have like a big CPI, jobs report, FOMC or something like that, that would generate that kind of event vol. You'd certainly not see another single stock that I can think of. Maybe Apple back in the day when people cared about Steve Jobs or something, you get a little something like that. But Nvidia is really the only one that does this. And so the argument is that the S&P term structure is reflecting the event itself, which reinforces its importance. It's not just this thing that we all keep talking about. I'm tired of talking about it. And if there wasn't an event vol, then I would move on with my life. But I can't. And we're here talking about Nvidia and its relative importance because the S&P is reflecting the importance of this. And we all know the narrative now. It controls the destiny of everyone else related to AI and blah, 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 blah. Okay, great. We all get it. So what is the potential movement? Well, if you just take a base case and you take VIX 23, if you use the rule of 16, you divide that 23 by 16, that tells you the implied one-day move for the S&P. So that comes out to be about 1.5%. And if we, again, go back to looking at the VIX term structure, as you can see here in the SpotGamma dashboard, short-term implied vols are up there at 30%. Right. And then when you zoom out in time a little bit, you're getting about 16. So these longer dated vols, if you just get out past really kind of Thanksgiving, you can see those vols come in around 18%. Now, if we look at forward implied vol, I'll describe this briefly as where vol should go after an event or where the target is for vol. What you see is that the forward implied vol is generally higher than the current S&P term structure, which generally just tells us that vol is well supported in this market, is how I look at this. If you look at a single stock like Nvidia and you go, what should the earnings do in the vol contraction be? You can see the forward implied vol is well below this, right? You're estimating about a 10 to 20% vol contraction after earnings, all else equal. So when I look at the S&P pricing, it seems fairly valued. You wouldn't expect that vol to come in a bunch, and that makes sense because realized vol is up around 15, 16% last time I checked. So we're getting a lot of market movement. Just today, we've already had 3 moves of 1%. So there's a lot of vol out there. And the question is that cheap or expensive, right? So that's why I started with this. So you're going, okay, 1 to 1.5% moves is what the market is roughly implying. And then when I look at the trace market and I say, okay, where's the support and resistance from a bigger, longer term perspective coming in? You start to look at the 6,800, which is, obviously more than 1% higher, talking 2 to 3% higher. And then when you look down at where those purple areas are, you're starting to look at around 65, certainly as a first stop, but 63.50 really starts to come into the picture as a major longer term support zone based on non-zero DT position. So we're looking at, I think, a 5% move over the coming, call it 10 days that round out November. The other argument that I've been making here, and the other thing that you have to consider again, is the Thanksgiving holiday. So people generally don't want to own options or be long vol through a holiday like that, particularly if the vol is expensive, which right now vol is relatively high. Now, if we look at the VIX term structure, this is a new feature we recently added, you can see that it is very flat to mild backwardation. This is obviously where risk sources from. It's not when we have very low or contango where the VIX is below all the futures. This where the term structure is flat, where volatility tends to explode, right? You have to sort of simmer before you boil is the argument. So, this is at the ready. We could easily on a miss, I think see a VIX 30 situation with all the other stuff going on, and S&P 6,500 is my base case on a miss or weak earnings, or just people not liking the narrative. I don't know exactly what the narrative people are looking for out of this is, but that is kind of the base case for first downside level, with 63.50 being, the more washout level. Then you're talking about VIX 30 in that scenario. That's a pretty good, volatility move. But then, of course, we jump immediately into Thanksgiving week. So I think people would be incentivized to sell some vol if we get that VIX 30 reaction, right? And then we have a chippy kind of ugly move from through the rest of this month, with the next major event being FOMC and Oracle earnings, which come up in mid-October, right? So you could have this really ugly regime, kind of like what we had through December, if there's an Nvidia miss, with 63.50 being that first downside. I believe, and I'm leaning on the fact, and I'm trying to structure some trades that bet on Nvidia meeting or beating, and then we'd see a vol contraction into Thanksgiving. I think that's where there's more interesting trades. And I'm starting to look at 7,000 still as the big level into kind of the FOMC mid-December timeframe. So those are the trades that I think at the moment are kind of interesting. Let's just do a quick scan of what we see in terms of positioning in these top names. Synthetic open interest shows us, based on our data, where hedge funds are long and short. And what do you see here in Nvidia? Positive gamma across the entire spectrum. So if people thought that Nvidia was a garbage company taking, inappropriate levels of depreciation or whatever else it may be, or there's a new Chinese chip that's going to steal their thunder, whatever it is, you would think they'd be buying a lot of puts. There's admittedly a pretty big put strike here. Looks like at 180, there's a big negative gamma strike, single negative gamma strike, but that goes away, I believe, with next expiration. But traders have a positive gamma position, not only through Friday's expiration, but through next week too, post expiration, which is that dotted line. So that does not strike me as a stock that has a lot of volatility potential based on just this positioning. There's a lot of after effects here, and with an implied move of 6 to 7%, it's pretty average, right? It's not all that exciting. And Jay says, doesn't see Nvidia beating. I have absolutely no idea. But all that matters is what people take from that earning. An inline thing could be enough for everyone to be like, okay, AI is fine, and let's buy it. Certainly a miss would be like, okay, buy more credit default swaps, which drives more single stock puts or whatever. That's like a problem. You look at Oracle, same position, right? There's a lot of positive gamma here. There's not a lot of long puts at this point. Stock is down 20% in the last 2 weeks. You look at Apple, for example, a lot of positive gamma everywhere. What about Meta? Meta has, interestingly, a lot of negative gamma to the upside. Meta is the singles, the one stock that has been kind of just punished after its earnings, and its earnings, as far as I understood, was okay. So Meta is a very interesting upside play, I think, here. If Nvidia beats or the market starts to catch a bid, Nvidia is one that I star as having a lot more potential upside volatility due to this negative gamma positioning. You see post this OPEX, that gamma is quite negative all the way up in the 700 area. So I've highlighted Meta as a very interesting name to play in upside out of this event. No analysis is complete without a look at Tesla. Tesla You know, a lot of positive gamma. It peaks in the 450 area, which was the previous sort of recent high in the stock. Not a lot of downside. Like, okay, there's a one big put strike here at 355, but under that, you know, positive gamma. So the single stock complex is not in this very negative position based on how funds are positioned, right? I think there's been some, you know, real money selling, obviously, people saying, I'm going to take my profits and run in some of these circumstances, but I don't see like this like capitulatory positioning, which is, you know, obviously a problem. If Nvidia misses, then you have to go from being funds are going to be short puts to long puts, and you have to traverse that. That could add to the downside volatility that I think is a pretty big concern. Additionally, if we look at NDX, two interesting things we were just talking about in the Interactive Brokers webinar is we had the big long call position, dealers long call from the QYLD roll. That's at 24.6. Interesting. That is exactly where the NDX is kind of pinning to is the moment. And then a lot of negative gamma to the downside in that complex all the way into 2,300. See that? 23,000, excuse me. Interestingly, if you look at the SPX, and I'm talking about that big negative gamma strike here, 63.35, I believe is the JP Morgan level. That's about the same amount of downside there. So that defined downside of, you know, 5% down, equating to roughly that 6,300, 23,000 area in the NDX, that seems to line up as, again, that washout area that I think we should all monitor pretty closely as the kind of big downside there. Yeah, QYLD, the NASDAQ option selling fund, that is what supplies a lot of that positive game, that systematic rolling. So that is how I've lined out. Now, why am I talking about 7,000 to the upside? If we just go and look at pure raw open interest, right, and there's still value in doing that these days. And we say, okay, where is all of the open interest in a given name? Here's total OI and volume. If I just shrink this in to look at more at the money strikes, you can see the last strike with any meat on the bones is 7,000, right? So this would be the quote unquote call wall. If we start to rally, big round number, you could easily see us. I think we're only down about 3, maybe now 4% from all time highs and just kind of sniffing that number. You know, obviously in a rosy scenario, when you start to crush vol, you can see that stuff really start to move up. That vol and Vanna flow really helped that move up. With I think 7,000 would be obviously a big fat number target for December. So that's the eye on the best possible scenario of upside strike with 6,800 right in here, kind of being, you know, the obvious short-term target in a bullish scenario. Now, what does OPEX look like in terms of what we are getting outside of that flow? I want to bring up another screen here. There we are. This is the delta notional for November 21st expiration. This is as of last night. Now, we look at things in terms of delta notional at SpotGamma because this tells you the stock equivalent. We all know how 13Fs are a load of BS in terms of like one contract equals 100 shares of stock. Well, the pervasive way that a lot of these other bank desks and people put this data out is one put equals 100 shares of stocks when they're telling you about $3 trillion notional of some expiration because they're assuming one contract equals 100 shares of stock. That's fake news, obviously, as we like to say around here. So what is the actual weighting? This is actually quite bearish. Normally into an expiration, and in recent expirations, we've seen 80, 90% of the delta value in calls, right, over puts. So the fact that we're at 50% in ETFs and index flow is really quite big. This is actually very negative in the single stock space. Usually single stocks is quite a bit higher. So even though calls are a larger portion there, there tend to be more calls than puts in the single stock space just anyways. So this is, when I look at this, this is a put weighted expiration, which if Nvidia starts to move, then what? These puts all get crushed, right? And so there's a lot of, this is a massive expiration. It's a decent size expiration. December is much larger, but this is just another thing that can add to the volatility of this event, right? The fact that that we are only 2 days away from that expiration. So, you know, you can see that positioning adding to the volatility of this event, right? And that is really what the key point is here. And so when you're thinking about earnings contraction and the potentially selling vol, you want to be careful of, I argue, selling vol, right, when vol doesn't seem too expensive, which is really the way that I frame this. And so we're all looking at what are the Nvidia earnings trades I want to make. It's not obvious to me that you want to sell Nvidia vol And I think you want to position carefully about the path dependency of volatility selling in index flow, because the move up could be violent. So you could have a day or two where it takes a day or two for vol to contract, right, to the upside. And then if there's any type of miss and downside move, well, VIX could easily go to 30 and you don't want to be short vol in that type of scenario. So Taif has mentioned LOI. Let's go ahead and move it to check that. QYLD, if you look at the biggest open interest for November 21st in the NDX, it is at 24,600. The QYLD roll will take place tomorrow, in which case they get rid of their position, 4,500 contracts at the 24,600 strike. It's 50 points under where the NASDAQ is currently trading, and they will roll to a new position. So that is the Mr. Omelet or Mrs. Omelet. I feel like Omelet's got to be a dude. Could be wrong. Let's talk about some specific earnings trades. And by the way, if you're interested in our OPEX spreadsheet, or you want to get this beautiful graphic on a rolling basis, if you go to spotgamma.com/OPEX, you can enter your chance to win every month. That you win it automatically. Everyone's a winner when it comes to the OPEX data. So please go check that out. All right, let's look at a couple of trades that I think are maybe interesting. I want to start with the scanners here. This is our Compass tool, which we built recently. And so what do we see here with a couple of interesting events? We talked about this in the founder's note, so SpotGamma subscribers are already aware of these dynamics. But hopefully we can add a little more meat onto the bones of what we talked about earlier. SMH is the other one. Nvidia right now is 50% IV rank, 50% risk reversal rank. So calls are basically in line with puts according to the last year of data. This is another way to say this is exactly average. Very uninteresting. Okay. Why would I trade that if it's very interesting? And at the 6 to 7% implied move, that's actually not that big of a move. I think Nvidia has had about a 5% move already in the last week, right? I think it's 12% for the month. I have to fact check me on that one, but there's been a lot of volatility. Realized vols around 43. So Nvidia earnings, playing Nvidia itself, just doesn't seem very interesting to me. Seems very average. What is more interesting? Oracle, a 100% IV rank and a call skew. Now that 1 month implied vol could be pricing in, or should be pricing in, some of the Oracle earnings itself. So that's interesting. And there's a call skew in there, which is crazy because the stock's down 20% over the last month. So there's people trying to buy that dip with calls. SMH, there's a real call skew there with elevated implied vols due to the Nvidia earnings. And then lastly, the Qs are way down here. Implied vol elevated, but no one wants calls in the Qs. So generally speaking, we would think that vol would contract and calls would get bid if Nvidia beats, right? If they miss, then you want some cheap downside exposure, right? Which is a challenge in this type of environment because vols are already pretty dang elevated. So that is the conundrum here when we start to look at trades. So I pre-populated some trades with our calculator. Now, if you are a SpotGamma subscriber, you have access to the calculator at all levels. If you're not, I feel sorry for you when you're trying to structure trades in this event, but you can join us if you'd like. There are, if you know some of the Bear Bull community, there's a great deal with them right now at the moment. And then we have some Black Friday stuff coming up too. So that'll be exciting, but that doesn't help you for Nvidia earnings today because the Black Friday stuff is the next week thing. Anyways, let's get back to the point. What are some of the trades I looked at? So I was looking at, and I had to do all this morning. So full disclosure, any trade I bring up here, the market has moved quite a bit since I put these trades theoretically on here. So you need to refresh these strikes, adjust these strikes. I am here to generate some ideas, and then you take those ideas and model them for your portfolio. I generally didn't want to put big positions on myself until we get closer to the close. And if you look at the way the market moved today, we went to 6,700 and then back down. So if you struck a bunch of trades at 6,700, you already are percent away, right? There's a lot of drift on, which is not kind of what I wanted to see. So I'm going to be looking to adjust strikes, move some of these positions around as we get into the close. So what's interesting about Oracle, the Oracle term structure has some very odd kinks in it. This is very elevated for the Nvidia event, and then it's also very elevated due to their earnings, which I believe I'll have to look that up. I think they're on the 10th. So there's a bunch of there's this weird dynamic, right, of this kind of kinked term structure. So one of the things that I think it could be interesting is if you believe the implied vol should be more stable for like regular DC expiration because of the events, you can lean on maybe owning that vol potentially if you believe that there could be a significant drawdown. What's interesting about this, if there's a market rally because Nvidia earnings are good and the AI story is okay, I think that the 1219 vol could still come in, right? Particularly if there's this rich call skew into that event. And then the argument here is that the stuff for next week may be a little cheap. Now, one of the things that is really driving a lot of the trades that I look at here is the idea that we're going to have immediately the weekend, the OPEX, the Thanksgiving holiday next week, which should generate a lot of time decay, right? So, that is the thing we want to think about. Luke says that the earnings are on the 15th, so thank you for that. We have FOMC in here. So, there's a couple of events. So if you buy the 1219 options, you're going to include the Oracle earnings and then obviously the FOMC. There's a bunch of events that should keep that vol relatively bid, right? Which is kind of an interesting feature of this market. So you talk about counter spreads, et cetera. I think that could be, or diagonals, that could be something kind of interesting. So what are some of the trades that I was playing around with into this? And again, please, do your own due diligence on this. This is just raw idea generation. But I was looking at this idea here for the Oracle Nvidia earnings, and it has a weird structure to it. But the idea is that if I open this trade up, on 11/28, you have the call spread here. This should be a short. So here's the call spread, right? And the idea is that stocks at 220, you could get a pretty quick rally off of this call spread, and the vol in these options is a little bit lower due to the fact that they're next week's 11/28 and not those longer dated expirations. So remember before I said if Oracle rallies, I think that December vol could come in because of the fact that Oracle may have a little bit of breathing room, right? And then you have the decay of those options, which are very rich because of all the events coming up, right? So if Nvidia beats, you can make a case that maybe Oracle, you get a sigh of relief. That vol comes in. Remember, the IV rank is 100. It moderates some and normalizes some. And so the idea here is that you can offset the cost of this short-dated call spread with with selling of this potentially expensive longer-dated call. And if Nvidia misses and the whole thing goes to, hell in a handbasket, then you're short this call with the market potentially crashing, and that strike is pretty high. So the argument being that you may be comfortable carrying this call if everything goes awry. And it sets up an interesting structure. And the reason I think this structure is interesting is because the argument here is at expiration, this would be the P&L of that trade. It's pretty limited downside risk in this case if there's a big miss, right? Whereas if we do get this very quick, very fast move, particularly if it happens in a few days, you can see that there's a lot of path dependency in this P&L, right? Where if there's a super move, you're in trouble. I don't think that's really much of the risk here. The idea here, you'd be holding this for a few days, potentially through Thanksgiving, and that decay and small rally, right? The idea being we get a jump out of the event, and then we would start to sort of trend a little bit sideways. That vol would potentially contract, et cetera. So this would be a trade that will only hold for a few days, potentially into 11/28, depending on how it plays out. But the idea is that I want to offset that extremely high implied vol in Oracle with potentially selling this, roughly 25 delta call. Now, again, the stock has moved quite a bit since I put this trade on, but that's the general idea. I'm trying to buy that cheaper 11/28 vol in options by selling the relatively more expensive options. This one is kind of fun. It's a QQQ YOLO trade, and I call it YOLO because the risk reward here is pretty, wild, right? What this trade is selling an at-the-money call. At the time, this was the at-the-money call. Qs are down to 598 now, so this is, again, strikes have moved. But you can do something like this where you sell one at-the-money option for DC and buy as many as 3 I was able to find of 20 delta options. So you're not buying like these super teeny options, but that 1/3 ratio is really interesting because if I think about, I own Qs, let's just say as a stock, I have a lot of risk. So in this case, you're getting more upside convexity with the same risk as the 1/3 structure here. And so what that kind of P&L looks like, you can see that here, where if you get an explosive move over the next couple of weeks, right, then you can see that P&L gets very convex if we move into the 630 to 640 area. That's just where we were 2 weeks ago, 630. Sounds like it's really far away, but it's only about a 5% move. And the fact that people would pivot towards calls means that call skew could potentially increase. And so we can model that out here in the SpotGamma portfolio, where we take call skew, for example, and just raise it. So let's say vol doesn't really move all that much, only about 1 or 2 points, and that call skew increases, right? You see that red line increase, so I don't move it too much. But you can model that out, right, where that call skew catches a little bit of a bid because now there's a chase into December, right? And then you can see how that P&L plays out via that purple line. So to me, if I could replace stock holding with this strategy, then that works out very well. The scenario where this trade stinks is obviously if the market rallies to 630 kind of after that December period, and I'm just sitting there with a short call, right? That obviously is not a particularly attractive scenario. But the idea here is that obviously the market would blow up if Nvidia just fails, right? And so this would be a type of trade that I would probably target, depending on the market moves, selling this into the energy of a big rally into the Thanksgiving holiday would be the general idea there. So interesting food for thought there. One of the more standard trades that you could look at is a call fly in something like SMH, for example. These are the 11, where do we go? The SMH trades. So this is a standard call fly, a little bit of a broken wing trade, 350, selling 3 of the 370s. So you want to mine that call skew. Remember in our scanner tool, we saw elevated call skews. And again, on 1128, the idea here is we're slightly out of the money on our call. So a 25 delta call, there's a big rally in the semis. That call will add a lot of value. Initially, this trade may look a little bit from a path dependent kind of scenario. This trade may look not all that great, as you can see here as we model it. But if that call skew flattens out, right, and vol settles into the big Thanksgiving holiday where there's a lot of decay, then you can see the P&L of this trade really starts to strengthen right around where the previous highs were in SMH. So I think this is a really interesting trade for upside at a decent price. It's not terribly expensive either. And then last but certainly not least is I was looking for a trade that was a good downside trade. I have 2 that I think are interesting. The Corweave one is this stock has been just absolutely pummeled right into the last 2 weeks. This is buying 160 put and selling 2 of the 50 strike puts. And the idea here is like, we know what the lower bound of the stock is, right? It's 0. And the odds are that this company goes out of business now by 12.5 is pretty low, right? It's already down 40% last 2 weeks. So in a bad Nvidia earnings situation, you could see the stock drift lower. So what I'm trying to do is get what amounts to free delta. And in this case, with the 60 strike put, it's $15 out of the money. So it's a teeny option right now. But if the stock starts to bleed down, right, then I will start to gain on this 15 delta put. And then the reason I sold 2 of these 50s is because these are potentially quite expensive on a relative basis. Now they're teeny puts and that they're 45 cents, but I don't have a lot of belief that the stock would move back below. And if you look at a long-term chart of Corweave, that's basically where the stock IPO'd, right? It would help if I put the right symbol in. This is where the stock IPO'd. So if we really zoom back on this and look 6 months back, I have to go a little bit farther back, you can see 40 to 50, right? So that to me would be this sort of technical support area where, okay, really bad situation, that's where that would settle down. And again, you can model not just the implied vol shifting, but the skews. And I don't know of another platform that really allows you to adjust the skews like this, which is critical to forecasting your P&Ls into events like this. This is part of every membership in SpotGamma, so standard through alpha. So you can get into here and you get SpotGamma alpha. We have a bunch of deals floating around. It's not hard to find them. So you get this for the price of just some calculators, because you're also getting founders notes and everything else, access to Q&As, et cetera, et cetera. So pretty good deal on that membership. Why do I think that the skew is elevated in Corweave? Well, if we just bring this up, and we've got to look at all the strikes here, all the expirations, and I'm gonna look at skew premium. What skew premium does, it says, okay, show me what the impact is of the skew, right, to the profit difference. Let me explain it a different way. We take the at the money vols and we plug them in the out of money options. And the difference there is what the skew premium is. And what you see is, go to all strikes, you see the heaviest skew premium are the lightest or the brightest numbers. So like the 50 strike here, for example, 26 cents of skew premium, that's a lot higher than some of the higher strike options, for example. And so if you're going to look at selling premium, you generally speaking want to buy the stuff with the highest skew premium. And then so buy the cheaper stuff, sell the more expensive stuff. That makes a ton of sense. Interestingly, upside, there's no real skew premium in these upside strikes. So Corweave would also be a potentially interesting play, just call spreads, right? If Nvidia rallies, and you can see that stock rally as well. So that's another interesting offset trade from just playing Nvidia itself, which to me, quite frankly, doesn't seem to show a whole lot of edge in that situation. So in Marisa, you like those back ratios. I think they're pretty interesting too in these events. The trouble is if you don't get that big vol move out of the event, like, up or down, that those can be a little bit tricky, but they can pay really well if you set up the risk. Scrolling through here, yeah, earnings are on the 15th. D. Greason says our positioning for both declined to 6,500 and also increased to 7,000. Yeah, so I have my main idea is I want to have some December positions, looking for that upside move. I'm leaning towards the upside move coming to fruition. Now, I want to, of course, have a situation where if I'm wrong, I'm hedged out or I am potentially, generating some P&L. And for that, I think that my favorite trades for kind of a tail move to the downside are in playing some really short dated options. So if you think about tomorrow or Friday, for example, what are the types of trades that you could put on that could potentially make a decent amount in this situation? Now, vol, again, is fairly elevated, right? So puts aren't free here. They're not like ridiculously expensive, but they're also not free. So you want to try to structure, in my view, these trades where you are able to get long some delta for as cheap as possible. And so we're talking about the key levels to the downside, and where it said 6,500 is full stop, is first stop in my view. And so can I get a 6,500 area put for a decent discount, right? So in this case, I'm going to model that out, and I'm just going to say, let's move these strikes down if I wanted to do that. Move this guy way down here, and then I'll move this to about 650, right? So, so the 650 area put in this case, right, is a 16 delta call. It's costing about $1. So the way that you would offset this is to say, okay, what options can I sell that would largely offset this, with the belief that that's the first stop. And so I can look at, something like a 640 call. Okay, those are 30 cents. So depending on how much I'm willing to outlay for this, do I want to go higher or lower based on that? And that seems like generally a good idea. And then I don't want to be exposed to the market if it just absolutely has like an Armageddon scenario, right? And we go to zero. You don't necessarily want to have, that as a proxy for downside. So without optimizing this much and doing this kind of live for tomorrow, you can see about 60 cents is roughly what we calculate this cost at the moment. And you're getting about $10 of downside protection there, which admittedly is just over 1.5%, right? And you could probably tweak this a little bit to find some, a little bit of a cheaper payout here. But the point is that I want to be long the 650 option. That's what I'm trying to do. And so in the event that we did get a decent drawdown in the market tomorrow, I'm going to be trying to monetize this structure in all likelihood into that 650 move. So in this case, you're hoping that you'll be able to close this for something like $5. You may just want to hold it to expiration. Obviously then you're hoping that we pin to 640 in that event. But this is the type to me of like decently cheap downside hedges that you can get. If you look at these, interestingly, if you compare this type to like an IWM, you may find a cheaper, similar put spread in IWMs or the Qs, right? You can play with those different indices because those three indices are all going to go down in conjunction, right? And you may be able to find a different index that has, but that risk reward of $60 for max profit of 900, I think is a pretty good one in this type of environment. Because look, here's the problem if you buy just the put itself, right? Obviously, you make a ton of money if the market really, jumps down, but your P&L there is basically the same, right? At 900, you're making, if we go to 640 rather, your P&L is kind of the same as the fly, right? $900 on either side. Obviously, you get more convexity. So like if vol really leaps, if vol goes up, let's say, 5 points, then you can see, the P&L is really going to jump quite a bit in that scenario. But if the market rallies, then you're paying twice as much, right? You basically outlaid $1 instead of the 60 cents. So, in the SPX, you're talking about much bigger dollar numbers. In the spiders, obviously, this is a $40 difference. But the point is the same, that you want to try to get that P&L for as cheap, or you want to get that exposure for as cheap as possible. And some of you would say, well, pardon me, some of you say, well, if you think the market is going to 650, then why wouldn't you do the 660, 650, 640 put fly? And it's because if the market drops that quick down to that area, that the P&L of that position is going to look quite poor, because this put that you're long, the 660, it's going to make some money, but the two that you're short, the 650s, are going to lose a lot more. So that's why I want to slide, in my view, slide that whole put fly structure down, because ultimately what I'm trying to do is generate positive P&L as the market rolls lower. And if I do that, then I can roll those positions, or I can shift those positions around. And if you go to 1121, you could slide that whole structure out, for example. So I think at this moment, when you're looking at the price of vols right here, going with at least a put spread to a put fly in that with this setup is the kind of thing you have to do, because the vols are relatively expensive, and you want to offset some of that vol cost. More downside here seems egregious. What's the funny thing about this is, and I would say, you talk about hedging only long positions. Yeah, I think you can hedge out long positions in a couple of different ways, depending on what your time frame is. But if you didn't hedge by now, then you're gonna buy puts into admittedly expensive vol, right? Not nosebleed like VIX 30, like, oh my gosh, but still it's pretty expensive out there. So then you can start to look at a put fly. The put fly is nice because it offsets some of that P&L, but you could go out a little bit more in time, right? And structure the same thing where you're saying, okay, 650 is the big downside level, but SPYs are trading at 660 right now, right? So you could enter into some other trades. It all depends on how much downside you're trying to hedge in these scenarios. So if that's $9, you want to offset some of that. Well, what would that take you down? So you look at something like this, right? Not cheap, right? $3. But the problem with this structure too is, if vol explodes, the P&L of this trade is not going to look very good, right? When the market falls apart, right? So if we look at current implied vol and we say, okay, what happens if vol goes up 5, 6, 7 points, because it's a really ugly scenario, then the P&L of this trade, again, is not going to look very good. It's not giving you very much hedge value, because you're short two options to offset that cost. So that's the problem with going out farther in time on these put flies, is you need the market to crash and then chill, right? Which is possible over the Thanksgiving holiday, but you can see that P&L gets much better if the market pins that specific zone, obviously. So even if you're hedging a long-only portfolio, use the short-dated put flies. I think that's totally reasonable. You can actually ladder them as well. So you could move this whole structure even further down, right, to do essentially the same thing. Let me get long a 600 put, for example, which is way out of the money at the moment, 10% of the money, but I can also structure put flies for tomorrow and kind of ladder them at lower strikes. And the idea being, let me try to get these deltas for as cheap as I can. I'll have some volatility sensitivity in the portfolio, but if I'm selling really far out of the money options, then even if vol spikes, it shouldn't hurt me too bad, because the put that I own, that main put that I own, that high strike put, should generate enough a gain in the down market to offset the losses of the two that I'm short. Hopefully that idea makes sense. And on that point too, as you mentioned there, again, there's nothing wrong with waiting to see which way this market leans and then playing the big directional move. I still think we're down for 3 or 4% move. So you can see the market hand here and then play a fairly large directional shift out of that. Let's talk about a couple of other interesting things, just in terms of how much volatility we've seen out of this market move. If you look at what the VIX has done, those of you who are SpotGamma subscribers know we watch this correlation metric a lot. And we're talking about how squirrely things were into the October 10th vol event, right? And we had this giant spike in VIX, and then right around October expiration, funny enough, third Friday of the month, we saw VIX go to 30. S&P was only down 2-3% that entire time. So now we're still only down about 3%. Things feel terrible. Vol is elevated, but we're really not moving all that much in terms of the S&P price space, right? The delta move, or however you want to phrase that price move, not actually all that elevated. Apologies for that. Not actually all that elevated, given what's happening, right? So there's this implies a lot of hedging in this space. Now, a lot of bracing for volatility. We don't get that volatility if Nvidia is just kind of average and we open up our eyes tomorrow and come in and the futures just kind of flat. Well, then suddenly anyone who owns puts are going to be feeling like these are pretty expensive puts, right? And we're coming into Thanksgiving. I got to sell those. And I think that makes the market starts to shift higher. And this is a market that chases, right? And then you start to get some reflexive order flow, starting to bid that stuff up. Correlation, you can see here, correlation went sub 8. This is the number that we flag as like, okay, there's a lot of volatility risk, over bullishness risk in this market. And you can see that is associated with these big VIX pops, right? So, there are these times where the options market is telling us that the options market itself is too bullish. The vols are screwy and we have to sort of reset. In this case, there's not that obvious overbought or oversold condition in either way. We're really just all dependent on the outcome of this event. And it's not only this event, even though this event will determine, I think, our outcome, because we have OPEX and then we have the Thanksgiving holiday. Again, I know I keep hitting on the layout or the time series of these events. FOMC, is a big one because we're 50-50 on an odds of a rate cut still. So, there's still that macro problem, obviously, right? But ultimately, to say that this whole bullish narrative is just reinvigorated because we're all going to go on holiday and things aren't that bad. How many times did we see the market redo this rally, right? We were even a little bit below here into that 10th spasm, right? We rally very quickly, we give it all back, we rally very quickly, give it all back. So the idea of generating a 3 to 5% rally here into the key kind of FOMC period doesn't seem to be all that, it's not all that hyperbolic of a statement, I don't think, just based on the type of volatility we've seen here over the past weeks. But again, Nvidia miss, you're talking about 63.50, that's where the support area starts to come in. That's a pretty solid 5%, downside move as well. And the market's not positioned for, I think, that type of move, right? That gamma driving that type of movement. And so I do think largely being short options, both calls and puts right now into this event doesn't make sense. If Nvidia beats and the market starts to rally and you want to sell some short dated premium, I think there will be an excellent opportunity for that once the market kind of opens tomorrow, right? Because the idea, again, the Thanksgiving holiday, okay, vol's going to get kind of pushed down because people are just going to turn to eating turkey and shelf the AI narrative potentially, at least for a couple of weeks. Someone was mentioning Bitcoin, and yesterday we were talking about Bitcoin. We posted on Twitter. Again, the options volume, already in Bitcoin at 900,000 is very high. Bitcoin was a top 10 volume name from basically like April-ish or even earlier in April down to about 2 months ago. And then when Bitcoin topped out, the volume disappeared, right? Ethereum, same thing. ETH, massive volume. BMNR, the Tom Lee joint, huge volume. Nobody gives a what now. They don't care anymore. But yesterday and today, really big IBIT volume, which is interesting because yesterday was a ton of calls. Today it's a ton of calls as well. And who's buying puts when the vol is already pretty elevated, right, in IBIT? I don't know anything about the crypto complex as a whole, so don't sit here thinking I'm making a macro take. But IV rank pretty elevated. Also, the fact that we're all the way left on that chart is telling us that puts are really big. No one cares about calls. That's not a shocking statement with Bitcoin just getting pummeled right over the last many weeks. So everyone's in puts. The implied vol is not like the most it's ever been, but it's pretty rich. And then suddenly we're starting to see this volume pickup yesterday and today. And this time's with Bitcoin crossing the kind of 90,000 level. I don't know if that's an important level or not, so I'm not going to sit here and say that. We're back down here below 89,000 again. I think one of the Winklevi said, this is the last time you'll ever be able to buy Bitcoin under 90,000. Turns out that wasn't true today. Maybe is. This certainly does not look like a great chart either. So, as far as my technical analysis skills go, it doesn't look too good. But there is this sign with this elevated volume and elevated call volumes that, maybe there's an attempt to buy some dips in this general area with that elevated volume. So I think that's quite interesting. The other one is Google. If you want to talk about things that you wouldn't see if the AI complex is done. Buffett bought it. Obviously, I don't know exactly what the timing of that is, but you look at that chart, and you don't think that the world is about to end, right? So I think that's kind of an interesting note as we check across the various stock complexes here, that this hasn't been the capitulation move, which you can look at that on both sides and say, well, the fact that we haven't capitulated and Nvidia misses, then we're going to get the capitulation, and that's certainly true. But as it stands right now, we could either go both ways, and I think that's the really interesting thing here, is that the vol seems underpriced, and that's kind of the feature that I think is most underappreciated. A lot of these names that were just incredible, I mean, they've all gotten washed out, right? We're looking at these drone names recently, and clearly overbought. Easy to identify that now, and okay, well, we've really reverted a lot, right? That overbought value just doesn't seem quite as exciting. People are asking about two things. LOI, I know the stock is just absolutely going bananas today, so that thing looks very good. As far as UNH goes, I don't have anything to say on that one. That was kind of been dead money for a while as well. So Andrew Cortado, I don't mean to tell you, I don't have much for you there, but those two names don't seem to be doing a whole lot. If you look at UNH, long gamma or positive gamma around 300 has been the same story forever. And people owning calls to the upside has also been around, but this is just kind of singing stick money, sticky strike, sticky money. You can see it just hasn't moved, right? And this is decent amount of positive again. It just says, seems like it's just going to sit there, right? That's just not that exciting. Eli Lilly, stock's at 1050. You see this pocket of negative gamma to the upside. This infers that 1100 or so might be where plenty of fuel up into that area. Over that, you see positive gamma above call sellers. So you got put sellers below, call sellers above that. So there's this little pocket of potential for a little bit more sneaky upside into that 1100 area, I would say. Seems to make sense. Buffett only deployed 0.01% of his cash on hand for Google trade. So yeah, to your point, but stock's still at 300 all-time highs. Can't be that bad, right? But yeah, the crypto space, man alive, that is quite ugly. So, all right, we're coming up near the top of the hour. I want to thank you all for joining us today. I hope this was helpful. I'm going to be on Chicago Future of Finance at 3 o'clock. I'll try to find some new and interesting things to talk about between now and then. I'm on, because I know you are a SpotGamma subscriber. I'm bringing this up. If you weren't, I would tell you to pound sand, sir. Just kidding. Look at this post-split, the fancy post-split Netflix. A lot of gamma at that 115, right? All of this goes away post-expiration. Do you see that? We go from tons of positive gamma here to it's gone, which is what that dashed line is, which is quite interesting. So it's this whole complex is going to reset with expiration. Stock has actually held up a lot better than the rest of the market. So if you're going to make a case for Nvidia no longer hanging around this 110 area, this is it, because that gamma is all gone. So this seems like maybe the moment you'll get some vol here. And then the skew curve looks pretty interesting. What is this? Vol's not that exciting. Puts and calls pretty evenly weighted. So I think Netflix looks like, if I had to guess, now may finally be the moment where we get away from this general area here, this 110, as a lot of this gamma expires. So the move seems to be setting up, probably dictated on what happens with the rest of the market writ large. And the vols are pretty average here too, right? If we had a big put skew or big call skew, you could lean on one maybe, but don't really see it there much. So I would think we're going to get maybe an outsized move now on Netflix into December, that a lot of this gamma is disappearing. All right, that's going to wrap it up for me here. If you have any questions, email us info@spotgamma.com. If you go to spotgamma.com/OPEX, you can sign up for the OPEX note that comes out that includes this fancy chart. We also include an OPEX spreadsheet. Also, by signing up at OPEX, you'll get notice of our Black Friday deals, which I understand are real and fantastic. So keep a heads up for those. And again, shout out to Bear Bull, Interactive Brokers, NASDAQ community. Thank you so much for joining us. And of course, SpotGamma subscribers, thank you most of all I'll be seeing SpotGamma subscribers tomorrow at 1 p.m. We'll talk about all the things that have happened in post Nvidia earnings. So we hope this is helpful. Temple English teachers, you are welcome. And then thanks again for the kind words. We will see everybody at 3 o'clock today for Chicago Future of Finance. You can find that via Oliver Rennick's stream. You can see I retweeted it yesterday. You can also find that one on, I believe, YouTube as well. And of course, again, SpotGamma subscribers, I will see you tomorrow at 1 p.m. for our private Zoom session that we do twice a week. All right, that's it for me. Good luck trading today. I hope for today was helpful. If these ideas were interesting, triggered something, did well or didn't do well, let me know. I'd love to hear about that stuff. You can get a hold of me, info@spotgamma.com, and let me know how it all hit. All right, that's really it. Thanks. See y'all later.